In the vibrant startup ecosystem of the early 21st century, innovation and disruption were the watchwords. Capital flowed freely, transforming ambitious ideas into billion-dollar realities overnight. It was an era defined by bold visionaries, daring ventures, and the relentless pursuit of growth at any cost. This fertile ground gave rise to companies that promised to revolutionize industries, leveraging technology to scale new heights. Amidst this frenzy, a seemingly simple concept would emerge, captivating investors and promising a radical new way of working, a vision that would soon sweep across the globe. At the heart of this revolution stood WeWork, a company founded on the premise of reinventing the workspace. More than just shared desks, WeWork offered a community, a lifestyle, a feeling. It was an ambitious vision, to create a global network of beautiful, flexible office spaces where creativity and collaboration could flourish. From its inception, WeWork aimed to be more than a landlord. It aspired to be a culture, a movement, a reflection of the evolving nature of work itself. Its promise was a compelling narrative that resonated deeply with a generation seeking meaning in their professional lives. Central to WeWork's meteoric rise was its co-founder and CEO, Adam Neumann. A charismatic Israeli entrepreneur with boundless energy and an even grander vision, Neumann was the embodiment of WeWork's audacious spirit. He spoke of elevating the world's consciousness, of creating a physical and spiritual home for members, and of making a global impact far beyond real estate. His infectious enthusiasm and unconventional style captivated investors, employees, and the media alike, transforming him into a startup icon whose every utterance seemed to hint at a brighter, more connected future. Alongside Adam Neumann stood his co-founder, Miguel McKelvey. McKelvey, with his background in architecture, was instrumental in shaping WeWork's distinctive aesthetic and community-centric design philosophy. While Neumann was the public face and the audacious visionary, McKelvey was often seen as the grounded creative force, translating the grand ideas into tangible, inviting spaces. Their complementary skills formed the foundation of the company's early success, crafting an environment that was both functional and aspirational, distinctively setting WeWork apart from traditional office providers. The genesis of WeWork can be traced back to 2008, when Neumann and McKelvey first experimented with a shared workspace concept called GreenDesk. Located in Dumbo, Brooklyn, GreenDesk offered eco-friendly co-working spaces. This initial venture, though modest, served as a crucial proving ground, allowing them to test the market, understand the demand for flexible office solutions, and refine their vision. The lessons learned from GreenDesk directly informed the foundation of WeWork in 2010, taking the core idea and scaling it with a much grander ambition and a more defined community ethos. A critical aspect of WeWork's appeal to investors was its aggressive rebranding as a technology company, not merely a real estate firm. Neumann consistently argued that WeWork's true value lay in its proprietary technology, its community-building algorithms, and its data insights into workspace utilization. This narrative allowed WeWork to command much higher valuations than traditional real estate businesses, drawing parallels to disruptors like Airbnb or Uber. The tech label provided a powerful justification for astronomical growth projections and an unprecedented level of investor enthusiasm. Fueled by this potent tech narrative and an insatiable desire for growth, WeWork embarked on an aggressive global expansion strategy. Locations rapidly appeared in major cities across continents, transforming the company into a ubiquitous presence in the flexible office market. The strategy was clear: capture market share quickly, establish dominance, and create a powerful network effect. This rapid geographical spread was a testament to both the company's operational capabilities and its immense funding, pushing its brand into new territories at an astonishing pace. A pivotal moment in WeWork's trajectory came with the substantial investments from Japanese conglomerate SoftBank, led by its visionary, albeit unconventional, CEO Masayoshi Son. Son, known for his gut-feeling investments and bold bets on technology, saw WeWork not just as an office provider, but as a critical piece of the future of urban infrastructure. His belief in Adam Neumann's vision was absolute, leading to billions of dollars in funding that propelled WeWork into stratospheric valuations and intensified its global ambitions. Masayoshi Son's investment philosophy often revolved around backing crazy founders with audacious dreams. He famously encouraged Adam Neumann to be crazier, pushing WeWork to grow even faster and think even bigger. This encouragement, combined with SoftBank's massive financial backing through its Vision Fund, effectively put WeWork on a hyper-growth trajectory, with little regard for traditional profitability metrics. Sun believed that scale and market dominance would eventually lead to profitability, a strategy that had worked for some of his previous ventures. The sheer volume of capital injected into WeWork by SoftBank and other investors was unprecedented for a company of its kind. Over several funding rounds, billions of dollars flowed into WeWork, enabling its relentless expansion and fueling its lavish corporate culture. This influx of cash allowed WeWork to subsidize rents, offer competitive prices, and invest heavily in its community initiatives, creating a seemingly unstoppable momentum. It was a clear signal to the market WeWork was a force to be reckoned with, backed by limitless capital. At its zenith, WeWork achieved a private valuation of an astonishing $47 billion. This valuation placed it among the world's most valuable privately held companies, a testament to the belief in its disruptive potential and Adam Neumann's captivating vision. The number itself became a symbol of the unicorn era, where growth, not profit, dictated value. This figure, however, was built on an intricate web of assumptions and aggressive projections, setting the stage for a spectacular reckoning when subjected to public market scrutiny. Adam Neumann's ambitions for WeWork extended far beyond simply providing office spaces. He envisioned a We company, encompassing all aspects of life. This led to a dizzying array of ventures: We Live, co-living spaces, We Grow, a private elementary school, Rise by We, a fitness center, and even a surf park. These initiatives, while demonstrating an expansive vision, also raised questions about focus and core business strategy. Investors began to wonder if the company was spreading itself too thin, diverting resources from its primary, already complex, operation. As WeWork's valuation soared, so too did Adam Neumann's personal wealth and extravagant lifestyle. Reports emerged of private jets, lavish parties, and significant real estate holdings. This personal opulence, while not uncommon among successful founders, started to draw scrutiny as the company's path to profitability remained opaque. The stark contrast between the company's community-focused messaging and its CEO's perceived self-indulgence began to create dissonance among observers and eventually, among its own board members. Compounding the concerns about Neumann's lifestyle were significant conflicts of interest. It was revealed that Neumann owned buildings in which WeWork was a tenant, effectively charging the company rent. He also trademarked the We brand and then sold the rights back to WeWork for a substantial sum, a move that particularly irked investors. These self-dealing transactions highlighted serious corporate governance issues, suggesting a blurring of lines between Neumann's personal interests and the company's welfare, raising red flags for anyone scrutinizing the company's operations. The moment of truth arrived in August 2019 with the public release of WeWork's S-1 filing, the mandatory document for companies intending to go public. This filing, meant to showcase the company's strengths and financial health, instead exposed a litany of red flags. The intricate details, previously obscured by private valuations, were now laid bare for the world to see. It revealed a complex corporate structure, significant losses, and numerous governance concerns that shocked even seasoned market analysts, setting off alarm bells across the financial world. The S-1 filing detailed several alarming aspects of WeWork's operations and governance. These included massive operating losses with no clear path to profitability, the aforementioned self-dealing transactions by Adam Neumann, and an unusual corporate structure that concentrated power in the hands of the founder. Furthermore, the document revealed an array of highly unconventional risks and philosophical statements, which seemed out of place in a financial prospectus. These issues, once hidden behind private funding rounds, now became undeniable public concerns. WeWork's corporate governance was particularly problematic. Adam Neumann held disproportionate control through a super-voting share structure, effectively shielding him from accountability. The board of directors, initially composed of allies and investors, appeared to have limited power to check his decisions. This lack of independent oversight and the opaque decision-making processes were significant deterrents for potential public investors, who demand transparency and robust checks and balances. The S1 laid bare a corporate structure seemingly designed to serve one individual's vision above all else. The S1 filing also dismantled the carefully constructed narrative of WeWork as a technology company. While it utilized technology for operations, its core business remained leasing real estate long-term and subleasing it short-term. This fundamental business model, reliant on extensive capital expenditures and market cycles, was inherently different from a software company's asset-light, high-margin structure. Investors quickly realized WeWork's valuation was based on a flawed premise, treating a sophisticated real estate firm like a pure tech disruptor. As the details of the S1 filing became public, a wave of skepticism swept through the financial community. Analysts and journalists meticulously dissected the document, exposing inconsistencies and alarming trends. Questions mounted about the company's path to profitability, the sustainability of its business model, and the appropriateness of its governance. The initial euphoria surrounding WeWork quickly evaporated, replaced by a deep-seated apprehension. The public market was proving to be a far harsher judge than the private venture capital world. The skepticism rapidly translated into a dramatic collapse in WeWork's projected IPO valuation. From an initial target of $47 billion, the number plummeted, first to $20 billion, then quickly into single-digit billions. Investors, once eager, now demanded a significant discount, reflecting the true risks and the company's underlying fundamentals. This precipitous drop signaled a loss of confidence in both the company's business model and its leadership, fundamentally reshaping its prospects for a successful public offering. Ultimately, the planned initial public offering was postponed, and then effectively cancelled, in September 2019. The market simply wasn't willing to accept WeWork at any valuation close to its previous private rounds. This failure was a catastrophic blow, not just to WeWork but to the broader startup ecosystem, signaling a potential end to the era of growth at any cost. The aborted IPO was a stark reminder that public markets demand a clear path to profitability and sound governance, beyond charismatic leadership and grand visions. The unraveling of the IPO prompted a furious backlash from investors, particularly SoftBank, whose multi-billion-dollar investment was now severely imperiled. Pressure mounted on Adam Neumann from all sides, the board, major shareholders, and even his closest allies. The consensus was clear: a change in leadership was necessary to restore investor confidence and salvage the company's future. The dream of a global we empire was rapidly collapsing under the weight of its own excesses and an unforgiving market. In a dramatic turn of events, Adam Neumann was forced to step down as CEO of WeWork in September 2019. This marked the end of an era, as the charismatic founder who had built the company from the ground up was unceremoniously removed. The decision was painful but deemed necessary by the board and key investors, primarily SoftBank, to stabilize the company and prepare it for a new direction. His departure symbolized the death of WeWork's original, free spending, and visionary-led culture. Despite his controversial exit, Adam Neumann walked away with a significant golden parachute. SoftBank agreed to pay him approximately $1.7 billion for his shares, forgive a $500 million loan, and pay him a $185 million consulting fee. This lucrative severance package, while designed to secure his exit and resolve outstanding issues, sparked outrage. Many saw it as a reward for failure, contrasting sharply with the job losses and financial struggles faced by WeWork employees and the substantial losses incurred by other investors. With Neumann gone, WeWork appointed Kosio Minson and Sebastian Gunningham to lead the company. Their immediate task was daunting: to cut costs, stabilize operations, and rebuild trust with investors. This marked a stark shift from the era of visionary expansion to one of pragmatic austerity. The new leadership signaled a focus on fundamentals, profitability, and transparent corporate governance, a complete reversal from the strategy that had defined WeWork's rapid ascent. The challenge was immense, requiring a fundamental overhaul of the company's culture and financial management. The new leadership immediately implemented aggressive cost-cutting measures, including extensive layoffs. Thousands of employees were let go as the company scrambled to reduce its massive overhead and become financially viable. Non-core ventures, like We Grow and We Live, were either scaled back or divested. This painful restructuring process was a direct consequence of the unsustainable growth strategy and lavish spending of the previous regime. It was a stark reality check for a company that had once promised a utopian work environment, now forced to confront harsh business realities. SoftBank, despite its colossal losses, stepped in with a massive rescue package to prevent WeWork's collapse. This included an additional $6.5 billion in financing and a tender offer to buy out existing shareholders, including Newman. This deep intervention transformed SoftBank from a major investor to effectively the owner of WeWork, highlighting the extent of its commitment and desperation to salvage its investment. The move was a lifeline, but it came at a tremendous cost, reshaping the power dynamics within the company dramatically. Under new management, WeWork began a slow, arduous process of reinvention. The focus shifted dramatically from rapid expansion and esoteric community narratives to core business fundamentals, profitability, efficiency, and prudent financial management. The company sought to shed its tarnished image and prove it could operate as a sustainable, disciplined business. This was no longer about elevating consciousness, it was about making the numbers work, optimizing existing locations, and carefully considering future growth. The transformation was profound, marking a clear break from its founding ethos. Just as WeWork began its painful turnaround, the COVID-19 pandemic struck, plunging the global economy into unprecedented uncertainty. The shift to remote work decimated demand for office space, delivering another severe blow to WeWork's fragile recovery. Empty offices and canceled memberships further strained its finances, pushing the company to the brink once again. The pandemic exacerbated all existing vulnerabilities, testing the resilience of the new leadership and forcing further difficult decisions about its future in a dramatically altered work landscape. In a surprising move, WeWork announced its intention to go public again in March 2021, this time through a SPAC, Special Purpose Acquisition Company, merger. The chosen SPAC, WeWork Acquisition Corporation, provided a path to the public markets without the traditional IPO process's intense scrutiny. This strategy reflected a more mature, cost-conscious WeWork, now valued at a significantly reduced $9 billion. While still a high valuation, it was a far cry from the $47 billion peak, indicating a more realistic appraisal of its worth. On October 21, 2021, WeWork finally became a publicly traded company on the New York Stock Exchange. The event was notably subdued, a stark contrast to the grand visions and celebratory atmosphere that would have accompanied its original IPO attempt. This quieter debut reflected the company's chastened approach, a focus on cautious growth, and the lingering scars of its tumultuous past. It was a milestone, certainly, but one achieved through a grueling journey of restructuring, loss, and recalibration, far from the unicorn glory days. The WeWork that emerged post-Newman and post-SPAC was one forced to critically re-evaluate its fundamental business model. The emphasis shifted from aggressive long-term leases and quick expansion to shorter, more flexible terms for clients, managing supply more efficiently, and reducing its overall real estate footprint. It sought to cater more directly to enterprise clients and hybrid work models, adapting to the post-pandemic reality. This was a recognition that the market had fundamentally changed, demanding greater agility and less risk. Despite its public listing and efforts at transformation, WeWork continued to face significant challenges. Profitability remained elusive, and the company carried substantial debt from its earlier expansion. Competition in the flexible office space intensified, with new players and established real estate firms entering the market. The specter of its past, including ongoing legal disputes and a lingering reputation for corporate excess, continued to cast a long shadow, making it difficult to fully escape its dramatic origin story and regain investor trust. Even after his tumultuous departure, Adam Neumann attempted a comeback. In 2022, he launched a new real estate venture called Flow, aiming to revolutionize the residential rental market. Flow quickly attracted a significant investment of $350 million from Andreessen Horowitz, a prominent venture capital firm. This investment stirred considerable debate, with some seeing it as a testament to Neumann's enduring charisma and vision, while others viewed it as a concerning endorsement of a founder known for corporate governance failures. The move signaled his undeterred entrepreneurial spirit. WeWork's saga offers invaluable lessons for the startup world. It underscored the perils of unchecked ambition, the importance of robust corporate governance, and the dangers of conflating hype with sustainable business fundamentals. The story serves as a cautionary tale against prioritizing growth at all costs over profitability, and against allowing a single, charismatic founder to wield absolute power without proper oversight. It highlighted the critical need for a clear path to generating revenue and realistic valuations. The WeWork story also shone a harsh light on the role of venture capital, particularly megafunds like SoftBank's Vision Fund. While VC money fuels innovation, it also risks inflating valuations, encouraging unsustainable growth, and sometimes overlooking fundamental flaws in pursuit of the next unicorn. The pressure to deploy vast sums of capital can lead to less rigorous due diligence and an over-reliance on founder charisma. WeWork became a prime example of both the power and the potential pitfalls of aggressive venture funding. One of the fundamental misrepresentations of WeWork was its persistent claim of being a tech company, when its core operations were firmly rooted in real estate. The difference is stark. Tech companies often have high margins, low capital expenditure, and easily scalable software. Real estate, by contrast, is asset-heavy, capital-intensive, and subject to economic cycles. WeWork's failure to reconcile this dichotomy was a major contributor to its valuation misjudgment and ultimate downfall. Despite its financial turmoil, WeWork undeniably tapped into a genuine desire for community and flexibility in the modern workforce. Its aesthetically pleasing spaces and curated events fostered a sense of belonging that traditional offices often lacked. This aspect of its offering was its true innovation and enduring appeal. However, the value of this community proved difficult to quantify financially and could not alone sustain a business model built on unsustainable growth and questionable financial practices, ultimately overshadowed by the corporate chaos. The WeWork story is also intrinsically linked to the broader evolution of flexible work. While WeWork's specific model stumbled, the underlying trend towards flexible and hybrid work arrangements has only accelerated, particularly post-pandemic. The demand for adaptable office solutions, co-working spaces, and on-demand meeting rooms remains strong. WeWork, despite its past, played a significant role in popularizing this concept, shaping expectations for how and where people work, even as it navigated its own existential crisis. The legacy of WeWork is complex and multifaceted. On one hand, it transformed the perception of co-working, making flexible office solutions mainstream and inspiring countless imitators. On the other hand, it stands as a stark warning about the dangers of unchecked ambition, poor corporate governance, and the fake-it-till-you-make-it startup culture when taken to extremes. It represents a watershed moment in startup history, marking a shift towards greater investor scrutiny and a demand for concrete financial viability. Reflecting on Adam Neumann's initial vision, it's clear there was a kernel of genius in recognizing the shift in how people wanted to work. He foresaw the demand for flexibility, community, and curated experiences long before others. However, this visionary insight was ultimately overshadowed by execution flaws, personal excesses, and a profound inability to translate grand ideas into a sustainably profitable enterprise. His story is a poignant reminder that vision alone, without discipline and sound management, is often insufficient for lasting success. Beyond the headlines and billions, the fall of WeWork had a profound human cost. Thousands of employees lost their jobs, often with little notice, their dreams shattered by the company's collapse. Small businesses and landlords who had invested in WeWork's ecosystem faced uncertainty. The narrative of We was ultimately replaced by a painful reality for many, serving as a stark reminder that corporate ambition, when left unchecked, can have devastating impacts on individual lives and livelihoods, extending far beyond shareholder value. SoftBank, once a primary enabler of WeWork's hypergrowth, was forced to dramatically pivot its own strategy in the aftermath. The WeWork debacle, coupled with other high-profile failures in its Vision Fund portfolio, led to greater caution, stricter due diligence, and a more conservative approach to investment. Masayoshi Son himself acknowledged mistakes, emphasizing a shift from excitement to discipline. This was a direct consequence of the massive losses incurred, prompting a re-evaluation of its entire investment philosophy. Despite its business model challenges, the core idea of community that WeWork champions still resonates. In a world increasingly fragmented, the desire for connection, collaboration, and shared purpose in professional environments remains potent. Future iterations of flexible workspaces, perhaps more sustainably managed and realistically valued, will likely continue to draw on this fundamental human need. WeWork's unique contribution wasn't just office space, but the ambition to make work a more engaging and fulfilling experience, a goal that continues to inspire. Before the spectacular crash, it's important to acknowledge what WeWork did right, especially in its early stages. They identified a significant market need for flexible, well-designed workspaces. Their focus on hospitality, events, and a vibrant atmosphere truly differentiated them from traditional office providers. They created a compelling brand that attracted startups, freelancers, and even large enterprises. This initial success, driven by genuine demand and clever branding, is what fueled the early investor excitement and rapid growth, laying the groundwork for later ambition. Adam Neumann's leadership style bordered on a cult of personality, or his vision and pronouncements were often taken as infallible. This intense personal connection with the brand and its mission fostered immense loyalty among early employees and believers. While inspiring, it also enabled a lack of critical scrutiny and decision-making. His charisma became a double-edged sword. It attracted immense capital and talent but also allowed him to operate with minimal checks and balances, setting the stage for the company's eventual corporate governance failures. Adam Neumann often spoke of WeWork as more than a company, but a philosophy, a way of being. The We ideology permeated everything, from office design to employee culture, aiming to foster collaboration and a sense of shared mission. This aspirational branding was powerful, resonating with a generation seeking more than just a paycheck. However, as the company's financial troubles emerged, the We philosophy began to ring hollow, overshadowed by reports of corporate greed and self-enrichment, exposing a chasm between rhetoric and reality. A major concern revealed in the S-1 filing was WeWork's staggering burn rate, the pace at which it was spending cash. With billions in funding, the company prioritized expansion and luxury amenities over profitability, leading to unsustainable operational costs. Analysts questioned how long WeWork could maintain this rate without going broke, especially as its revenue growth didn't keep pace with its expenditures. This aggressive spending, masked by private funding, became a glaring liability under public scrutiny. WeWork's reliance on long-term leases and short-term rentals made it vulnerable to fluctuations in the real estate market. When the market was booming, its model could generate revenue, but a downturn exposed its inherent risks. It was effectively taking on the risk of fluctuating occupancy rates and property values, a gamble that traditional tech companies don't face. This fundamental vulnerability, combined with its rapid expansion, created a highly leveraged position that was unsustainable in the long run, especially during economic shocks. WeWork also faced an increasingly competitive landscape. While it pioneered the modern co-working model, many other players quickly emerged, from smaller boutique providers to established real estate giants like Regus, now IWG, and other flexible office solutions. These competitors often offered similar amenities and flexibility without the same overhead or corporate baggage. This saturation of the market made WeWork's path to dominance even more challenging and its claims of proprietary advantage less credible, eroding its unique selling proposition. To fuel its aggressive expansion, WeWork accumulated a staggering amount of debt. While venture capital provided equity, debt financing allowed the company to acquire properties and fit out spaces at an accelerated pace. However, this debt came with interest payments and repayment obligations that significantly burdened the company's financial health, especially as revenues faltered. The combination of high burn rate and substantial debt created a precarious financial position, making the company highly sensitive to any market volatility. The We in WeWork was intended to symbolize community and shared success, yet the company's trajectory revealed a paradox. While projecting an image of inclusivity, the financial benefits and power were highly concentrated, particularly with Adam Neumann. This dissonance between the aspirational we and the actual I of its leadership became increasingly apparent as the S1 filing peeled back the layers of corporate governance. It underscored the challenge of building a truly communal enterprise within a capitalist framework driven by individual incentives. The WeWork implosion sent shockwaves through the venture capital community. It forced investors to re-examine their due diligence processes, particularly for unicorn startups led by charismatic but often unconventional founders. There was a renewed emphasis on profitability, sustainable business models, and robust governance structures, rather than simply betting on exponential growth. WeWork became a cautionary tale, prompting a more mature and disciplined approach to investment across the tech and startup sectors, moving away from purely speculative bets. Looking back, many argue that WeWork's fall was not inevitable. Had there been stronger independent governance, a clearer path to profitability from the outset, and less personal enrichment by its founder, its story might have been different. A more measured expansion, perhaps focusing on core markets and disciplined spending, could have built a sustainable business. The lesson suggests that even the most innovative ideas require foundational business discipline to succeed in the long term, regardless of how much capital is available. WeWork paid a steep price for its inflated hype and unrealistic valuation. The relentless pursuit of an ever higher valuation, fueled by investor excitement and founder ambition, created a bubble that was bound to burst. When confronted with the cold, hard realities of public market expectations, the discrepancy between perception and reality became too vast. The story is a powerful reminder that while hype can generate momentum, it cannot sustain a business lacking fundamental financial health and a viable path to long-term success. The we in WeWork, intended to symbolize community and shared success, ultimately became a paradox. While projecting an image of inclusivity, the financial benefits and power were highly concentrated, particularly with Adam Neumann. This dissonance between the aspirational we and the actual I of its leadership became increasingly apparent as the S1 filing peeled back the layers of corporate governance. It underscored the challenge of building a truly communal enterprise within a capitalist framework driven by individual incentives and unchecked ambition. The WeWork implosion profoundly impacted SoftBank's investment philosophy. Masayoshi Son, who had famously encouraged Adam Neumann to be crazier, was forced to confront the harsh realities of unbridled ambition. SoftBank shifted its focus towards more disciplined investing, greater emphasis on profitability, and closer scrutiny of corporate governance. The scale of the WeWork write-down served as an expensive lesson, reshaping how one of the world's largest tech investors would approach future deals and founder relationships, moving towards a more measured approach. Today's WeWork is a shadow of its former self, yet it persists. It operates with a leaner structure, a more pragmatic approach to its real estate portfolio, and a renewed focus on its core business. The grand ambitions of We Live and We Grow are largely relics of the past. The company continues to navigate a challenging market, aiming for sustained profitability and stability rather than exponential growth. Its journey from a $47 billion valuation to a publicly traded entity struggling for consistent profitability encapsulates one of the most dramatic business stories of our time. Despite WeWork's specific travails, the fundamental demand for flexible workspaces has only grown stronger. The COVID-19 pandemic accelerated the adoption of hybrid work models, making adaptable office solutions a necessity for many businesses. WeWork, even through its crisis, inadvertently validated the market for flexible work. The challenge for WeWork and its competitors remains in how to profitably deliver these services in a highly competitive market, ensuring the business model is as robust as the demand for flexibility. Adam Neumann, despite his controversial past, remains a figure of intense interest in the startup world. His ability to attract significant investment for new ventures, like Flow, demonstrates a remarkable resilience and continued belief in his own vision. Whether he can translate this renewed capital and entrepreneurial drive into a sustainably successful and ethically governed enterprise remains to be seen. His future endeavors will undoubtedly be watched closely, offering further insights into the complexities of leadership and startup dynamics. The WeWork saga created a significant ripple effect across the entire startup ecosystem. Investors became warier, due diligence became stricter, and the move fast and break things mantra faced a stern re-evaluation. Startups seeking funding were increasingly challenged to present clear paths to profitability, rather than just impressive growth metrics. This shift, while painful for some, arguably injected much-needed discipline and realism into a market that had perhaps become overly speculative, fostering a healthier environment for long-term sustainable growth. A key takeaway from WeWork's downfall was the urgent need for corporate governance reforms. The concentration of power, lack of independent oversight, and conflicts of interest highlighted flaws that are now being addressed more rigorously across the startup world. Founders are increasingly expected to cede some control as their companies grow, and independent board members play a more crucial role. This push for better governance is designed to protect shareholders, employees, and the long-term viability of the company, preventing similar catastrophic failures. The WeWork name itself became synonymous with both boundless ambition and spectacular failure. Once a symbol of innovation, it now often serves as a cautionary tale. Rebuilding trust and shedding this association is an immense challenge for the company. Despite its struggles, the brand retains a level of recognition, albeit a complicated one. How the company navigates this reputational burden, balancing its past with its future aspirations, will be critical to its long-term survival and potential for a genuine turnaround in the coming years. For the new WeWork, the singular mission remains the elusive search for profitability. After years of colossal losses, the company has to demonstrate to investors that its model can generate sustainable positive cash flow. This involves optimizing its vast network of spaces, increasing occupancy rates, managing expenses diligently, and focusing on high-value clients. It's a fundamental shift from the growth-at-any-cost mentality to one rooted in financial discipline, a slow and painstaking process essential for its long-term survival in a competitive market. The spectacular rise and fall of WeWork truly marked the end of an era of unchecked venture capital, founder worship, and valuations decoupled from reality. While innovation continues, the market's appetite for highly speculative bets has waned. The WeWork story serves as a potent parable, a dramatic illustration of what happens when ambition outstrips execution, and when the move fast and break things ethos breaks down the very foundations of good business. It's a story that will be studied for generations, offering enduring lessons. The co-working industry itself continues to evolve, shaped by the lessons of WeWork and the demands of a post-pandemic world. Flexible workspaces are still highly desired, but future success hinges on sustainable business models, stronger partnerships with landlords, and a more diversified client base. The focus is now on resilience, adaptability, and clear financial pathways. WeWork's journey, though fraught with peril, ultimately helped define the parameters and highlight the opportunities for the next generation of flexible office providers, ensuring continued innovation. WeWork's dramatic trajectory from a $47 billion valuation to a struggling public company will forever stand as one of the most compelling cautionary tales in modern business history. It serves as a vivid illustration of the fragility of hype-driven valuations and the critical importance of foundational business principles. The story of Adam Neumann, SoftBank, and WeWork is a complex tapestry of innovation, ambition, hubris, and profound financial misjudgment, a narrative that continues to unfold, offering invaluable insights into the dynamics of the 21st century economy. The lasting impact of WeWork extends beyond its own corporate struggles. It reshaped venture capital investment, influenced corporate governance standards, and fundamentally altered public perception of high-growth startups. It left an indelible mark on the real estate sector and the way companies approach workplace strategy. While its path was chaotic, its story undeniably contributed to a more sober and discerning market, forcing a re-evaluation of what truly constitutes value and sustainable growth in the fast-paced world of innovation and disruption. The story of WeWork is, in many ways, still unfinished. The company continues to operate, striving for a profitable future. Adam Neumann has launched new ventures, eager to prove his critics wrong. The broader implications for venture capital and corporate governance are still being debated and refined. WeWork's journey from dazzling success to near collapse, and its subsequent attempt at reinvention, provides a captivating and complex narrative, a true epic of modern capitalism that continues to offer lessons for founders, investors, and workers alike. Even years after his departure, the specter of Adam Neumann continues to loom over WeWork. His charismatic, albeit controversial, leadership shaped its identity, and his decisions laid the groundwork for its subsequent crisis. While the company strives to move beyond his influence, that Adam Neumann chapter remains an inseparable part of its history. His ghost in the machine, so to speak, serves as a constant reminder of the fine line between genius and recklessness, and the profound impact a single individual can have on a multi-billion-dollar enterprise. SoftBank's journey with WeWork is equally as complex. Having poured billions into the company, it effectively became its rescuer and primary owner. This means SoftBank remains deeply invested in WeWork's turnaround, highlighting the long-term consequences of its initial audacious bet. The performance of WeWork, even in its reduced state, continues to impact SoftBank's overall portfolio and its reputation. Their intertwined fates demonstrate the powerful, and often risky, symbiotic relationship between large investment funds and the startups they champion. In the annals of business history, WeWork will occupy a unique, perhaps infamous, position. It's a tale that encapsulates the dizzying heights and spectacular crashes characteristic of the 21st century tech boom. A cautionary narrative on ambition, governance, and the often fragile line between perceived value and fundamental reality. Its story will be studied for years to come, dissected by business schools and analysts alike, as a prime example of both the incredible potential and the inherent dangers within the world of high-stakes startup financing and rapid global expansion. WeWork captured the zeitgeist of a generation that sought more than just a job. They wanted purpose, community, and flexibility. This desire was, and remains, very real. The irony is that the company built to serve this we generation ultimately prioritized the lie of its founder, leading to its downfall. The question now for future companies is how to genuinely foster community and offer flexibility while maintaining sound business practices and ethical leadership. The aspirations remain, but the pathway to achieve them has been dramatically re-evaluated. The WeWork saga is ultimately a story about the devastating cost of corporate excess. Lavish spending, disregard for financial discipline, and a leadership style that blurred personal and corporate assets created an unstable foundation. The billions poured into the company were not invested with sufficient prudence, leading to massive write-offs and widespread losses. This tale serves as a powerful testament to the fact that even in the most innovative and rapidly growing sectors, fundamental economic principles cannot be ignored without severe consequences. The road ahead for WeWork is still long and fraught with challenges. While it has survived its near-death experience, it must continue to adapt to changing market dynamics, intense competition, and the lingering distrust of investors. The company's ability to consistently generate profits, shed its debt burden, and evolve its offerings will determine its ultimate fate. It is a battle for relevance and profitability, far removed from the utopian visions of its inception, but critical for a company striving to define its second act in the competitive world of flexible workspaces. In its prime, WeWork's vision was genuinely captivating, a global network where work was inspiring, collaborative, and deeply connected to life. This vision, however flawed in its execution, tapped into a powerful human need. As we reflect on WeWork's journey, we are reminded that powerful ideas, when paired with reckless management, can lead to both incredible highs and catastrophic lows. The ambition was undeniable, but the guardrails were missing, creating a story that will resonate for years as a lesson in both aspiration and admonition.